Think of the economy like a game of musical chairs where the chairs represent money. When a recession hits, it's like the music stops, and some people and companies find themselves without a chair, metaphorically speaking. This situation continues until the music starts up again. During recessions, the velocity of money slows down. This means money isn't changing hands as quickly, leading to less money circulating in the economy for you to grab hold of. As a result, people tend to hold on to their cash, which leaves businesses with less money to invest in growth or support their current workforce. Job losses pile up, reducing people's spending power and worsening the economic downturn. However, not everyone suffers during recessions. In fact, this is when some individuals, often referred to as sharks, capitalize on the situation to benefit themselves financially. In the following points, you'll discover the strategies that millionaires and billionaires follow during economic downturns. Here are 7 rules to navigate through a recession and thrive financially. First on our list, hold on to your available cash. Cash holds a special position during tough economic times because it becomes scarce. Being unable to access cash when you need it most can jeopardize your financial stability in the long run. In times of economic downturns, cash transforms from a mere currency to a crucial asset. It acts as your safeguard, protecting your investments and ensuring your peace of mind. While nobody enjoys watching cash sit idle in a bank account losing value to inflation, having it readily available becomes essential, especially in uncertain economic climates. Wealthy individuals are comfortable with the idea of losing a small percentage of their wealth each year, understanding that they'll have the means to capitalize when opportunities arise. When the market experiences a significant downturn, they have the luxury of holding on to their cash reserves. For those caught in the middle, it might be prudent to delay significant spending decisions and adopt a strategic approach, akin to playing chess while others play checkers, to navigate through challenging financial times. Keep away from high-interest debt, but consider low-interest options. During uncertain times, the value of capital increases significantly, making borrowing expensive. Taking on high-interest debt amid a recession is akin to swimming with weights tied to your ankles. It's bound to drag you down eventually. Therefore, it's advisable to avoid accumulating debt and instead navigate through the recession with whatever income you have. We'll delve into income strategies towards the end of this discussion. Recessions present an opportune moment to renegotiate debts and contracts. People, fearing they may never recover their money, are often open to offering more favorable terms. It works both ways. Lenders may become predatory, seeking to capitalize on others' financial distress. Hence, if you aim to prosper, position yourself as the predator rather than the prey during economic downturns. Moreover, recessions favor structuring deals with debt rather than equity. Debt agreements offer tax advantages as they can be written off and provide simpler exits for investors. Opting for equity entails the risk of losing everything if the business fails. With debt, there's flexibility in recovering capital. For investors seeking the best of both worlds, convertible debt deals allow the option to either receive repayment or convert it into equity later, when the economy stabilizes. The powerful thrive, while the weak falter, often bought out for a fraction of their worth, consolidating control. Recessions act as a natural purge in the economy, eliminating inefficient businesses and those who overstretched beyond their capabilities. These struggling enterprises, lacking solid financial foundations, face 2 options: either endure heavy losses or minimize them by selling out to larger, more resilient players who weather the storm. This dynamic allows big players to capitalize by acquiring smaller ones at reduced prices, thereby expanding their market dominance. This process concentrates power into the hands of a select few, evident in the surge of mergers and acquisitions among major corporations and the disproportionate closure rates of small businesses. For instance, over 200,000 small businesses shuttered during recent economic downturns. This trend further manifests in the substantial growth of market share for dominant players. Large corporations not only absorb smaller competitors, but also enjoy privileged access to financing and a shift in employment patterns, attracting top talent once available to smaller enterprises. Consequently, when the economy rebounds, the wealthy reap the benefits of increased assets and market share gained during the downturn. While smaller entities struggle to stay afloat, there may still be opportunities for those not yet among the elite to find their own path to success amidst the shifting economic landscape. Prioritize logic over emotion. When navigating through recessions, survival hinges on rationality, distinguishing between seasoned professionals and mere pretenders. The right decision isn't always the easiest or most comfortable. It's the one backed by data and analysis. While instincts are valuable, numbers provide an undeniable truth. Consult the scoreboard and adapt accordingly. If trimming 20% of your workforce ensures the ship stays afloat, decisive action is imperative. Emotional choices may offer temporary relief, but if the entire enterprise founders, everyone suffers. Emotions obscure the path to prosperity. Making data-driven decisions, grounded in the long-term vision of the project, minimizes stress and fosters confidence in the face of uncertainty. Each decision becomes a building block toward the business's future, ensuring resilience when the dawn breaks anew. Exercise patience and precision in your moves is a key lesson from the wealthy. Unlike most, they possess the virtue of patience, waiting for the opportune moment to act. Take Warren Buffett, for example, who endured 8 years of scrutiny from financial pundits while holding onto his cash reserves. When the pandemic hit its peak, Buffett's Berkshire Hathaway was sitting on $150 billion, ready to pounce. As markets hit rock bottom, Buffett swooped in, acquiring excellent companies at massive discounts. The takeaway? Learn the art of patience. Focus on markets you understand intimately. Avoid chasing trends or investments beyond your comprehension. It's unwise to spread yourself too thin across assets you can't control or fully grasp. Instead, concentrate your efforts on areas where you have expertise. For instance, if you're a farmer with surplus cash during a recession, consider investing in land or cattle when prices are favorable. Remember, making one well-timed move during the span of a recession can outperform a flurry of hasty decisions. Patience, coupled with precision, is the hallmark of successful investors during times of economic turmoil. Maintain stable prices and prioritize smart spending. As you've likely noticed, the cost of living is on the rise, while people's spending power diminishes during a recession. This dynamic intensifies the need for careful financial management. Increasing prices during tough times is a risky move. While it may seem like a quick fix to offset losses, it often results in losing more customers than gaining additional income. Take the example of a fashion e-commerce company that attempted to hike prices during the pandemic. Despite catering to a loyal fan base, the decision backfired, leading to a costly lesson learned over 2 years. Instead, focus on optimizing production costs and maintaining reasonable prices to retain customers. During a recession, every dollar becomes precious. Respect its value by refraining from indulgent purchases like new cars, luxury clothing, or exotic vacations. Instead, conserve capital and invest it wisely in income-generating assets. As the recession wanes, these assets will provide the means to afford the luxuries you desire without jeopardizing financial stability. It's a strategy that prioritizes long-term financial health over short-term gratification. And lastly, secure your income to stay afloat. In uncertain times, your ability to monetize your skills is your lifeline. Whether you're an individual professional or a business owner, your capacity to deliver valuable services or products and manage resources efficiently is paramount. Building a solid foundation ensures a steady cash flow, which is essential for weathering economic storms. Vigilantly monitor your cash flow, understanding every inflow and outflow to identify areas for improvement and strengthen your financial health. While savings are vital, they're best reserved for seizing opportunities rather than enduring prolonged downturns. Your goal should be to maintain a consistent income stream month after month, providing predictability and a reliable basis for decision-making. Control over your income empowers you to outperform those who passively observe market shifts. Additionally, during times of crisis, your network becomes invaluable. True friends and lasting relationships emerge, offering support and opportunities for mutual growth. Despite signs of a recession, governments may attempt to artificially boost economic indicators, creating a sense of unease among the populace. While corporate earnings may appear robust, the underlying reality may be less favorable. It's crucial to remain vigilant and discerning, focusing on long-term strategies that safeguard your family's interests and capitalize on emerging opportunities. In times of uncertainty, playing the long game and nurturing meaningful connections can yield significant dividends. Stay attentive, adapt to changing circumstances, and prioritize resilience to thrive in turbulent times.